Hey guys, this is Market Update. In this video, we're going to be looking at one of the most important metrics, I think, for Bitcoin and crypto, which is liquidity. Banking liquidity and bank reserves, they move in these waves, and these seem to have a big effect on crypto prices. So if we can see where we are in this cycle and how things are going, that's going to affect this Bitcoin cycle as well, because there's still a lot of negativity about inflation. But let's be fair, inflation doesn't really matter for Bitcoin that much. If you go to countries where there's rampant inflation, Bitcoin is at massive all-time highs in those countries. So inflation doesn't affect things as much as we think. It's actually central banks and how they manipulate the currency that affects Bitcoin. So if we know that currency units seem to be rising again, that's going to affect the price of Bitcoin positively. More currency units chasing the same amount of BTC. And so we'll have a look at how that's reacting in this video. So for right now, we're just drawing down from the all-time high, right? So we're still in this kind of drawdown or consolidation out. You can see that the price level here is 57,000 where we touched it once. So we could actually come into that again and maybe we bounce off it. The second line down here is around 50K, which would be a bigger drawdown. Something that I would really love to buy as well. 32% drawdown would be ideal. That would be the biggest drawdown of this bull market. However, you can see that we are in a big uptrend. We're just creating higher highs, higher lows. It's a massive uptrend. It's a massive bull market. You'll see the data here that shows that M2 is starting to grow again. More currency units chasing the same amount of BTC is generally pretty bullish, despite all of the FUD around inflation. If currency units are increasing, then risk assets going to price that in. If you do trade, check out the deposit bonus to Bybit. If you're new on there, click the link down in the description. If you make a deposit there, you can get a deposit bonus up to 30K to trade with. You can check the link down below for the details. As I've said in other videos, I think there's really two major factors for the price of BTC. The first one is its own fundamental adoption. It has a price because it's desirable for some amount of people. And so if more people join, then generally it's going to price in more people storing some of their wealth in it. So that's just fundamentally to Bitcoin and other crypto assets and other assets generally that have some sort of growth as a network or a business. Then you have the other side, which is the amount of currency units that are chasing those assets. And so those two things lead to the price of the asset. So if more currency units are being printed out, we obviously need to be in assets that price that in. We definitely can't be in the currency unit that is being expanded. That's a very, very poor store of value or anything, right? So you're actually getting debased if more currency units are coming into existence. So we had this huge, pandemic expansion, massive bull market, assets priced in the amount of new currency units. Then we had this huge bear market as we drew that down. As you can see now, it's not that we're positive, but we're getting to that stage, right? So actually at M2, if you look at some other metrics like M2, it looks like it's actually starting to inflect again to the upside. M2 money creation, right? Bank deposits, the more currency units. Where does money come from? The banks literally create it out of thin air, right? But they can't just create it out of thin air. They have to take risk, right? Have to create credit. And obviously the central bank is, part of that as well, trying to manipulate how much credit they create. Credit, essentially new currency units based on some sort of asset, either a business idea, a property, etc. Well, we can see these currency units are starting to turn, right? So it's not that it's, way up here like we had in the pandemic, but the rate of change matters for assets. And so we had this big drawdown during the Bitcoin bear market, but now it's turning positive again. And Bitcoin sniffed it out a long time ago when the mini banking crisis happened in the States, and everyone's thought, well, they're going to have to actually create more currency units here. They're going to have to bail them out. They did. That's when the bull market started. Essentially, it's still happening. So Bitcoin really reacted a lot to that. It sniffed it out. Bitcoin is a leading indicator, not lagging. So it's going to lead all of this stuff. We're leading now. And it seems like the inflection is happening from negative back into somewhere neutral. So if I'm looking for M2 just to go, or this is system liquidity, so I just call it system liquidity, go back to the neutral area, which I think will happen, then that's going to be positive for risk asset prices generally. Bitcoin is definitely a leading indicator. It's not going to wait for all of the lagging stuff to show us that we're in some sort of expansion or anything. It's going to show us that at the time it's happening. All of the economic data is lagging. Bitcoin really is, and the markets generally are leading indicators for that. Now, this is the current Bitcoin drawdown from the all-time high. It's a 20-25% drawdown, which is extremely normal and typical. This is not a big drawdown at all, unfortunately, for people that want to accumulate this stuff. However, we touched the all-time high. And where we are right now in this bull market is, not early, say mid-stage if you want. You can see that each time we have this kind of new bull market, right? And this huge price appreciation for BTC, it doesn't just touch it once and then come down. It kind of touches it, big drawdown, another run, big drawdown, another run. So we're kind of in the middle of it right now. We're in the middle of this bull market price expansion. And this touching it one time and then drawing down and going into a bear market is very, very unlikely. It's way more likely, as you can see from each of these previous expansions, that we are now in this kind of roller coaster stage of huge expansion, big drawdown, huge expansion, eventually getting to the top at some point. This could carry on for another, let's say 12 months or so, somewhere around that. So we are kind of in it right now. So for right now, if you are trying to think about things, if you're looking to accumulate, we are in the stage where I think the next expansion, if we have it, whatever price that gets to, if you're more price sensitive, you have to be looking at buying drawdowns, then buying dips rather than just dollar cost averaging. If you're not as price sensitive, maybe it doesn't matter as much. But as we get more mature, the price of Bitcoin for this cycle is going to start to get to an area where, if you're price sensitive, maybe you should cut back or stop buying, right? If you're not price sensitive, then maybe just stomach the price. But we are in the bull market, and so eventually it's going to get mature enough where the price just doesn't make sense. I still think it does make sense at this level though, but hopefully this shows where we are in this current bull market, which is not early. We're kind of right in the middle of it. And talking about those two things that affect the Bitcoin price, so its own adoption and the amount of currency units chasing it. So the first thing is Bitcoin adoption is absolutely fine. So we know that this thing is being adopted. It would be very unusual for it to stop now. So with the underlying agreement that this network is growing and continuing to be adopted, which is absolutely essential. If it doesn't, then obviously it's not going to go up in price. So adoption is continuing. With that in mind, we have to look at the second part. So are currency units going to be created out of thin air? And the answer is probably yes. So this is Raoul Pal from GMI. So what we want to look at is liquidity, like I said, net liquidity at the start of this video, and how that works with government debt. So we know right now that in the States, there is a massive, massive fiscal deficit. So they're spending way more money than they're earning in tax. And the way they do that is creating debt. So they create the bonds, and savers take their cash and put it in bonds. Now, even if you don't want to, because if you're using a bank, which our fiat currency will be in a bank, all of those banks buy all the bonds as well, even if you don't want to buy the bonds. They're buying the bonds, and the rate is at the moment 5%, but they have to pay interest on that. But they're taking that money from savers, they're stealing it away from them and pushing it into the economy in ways that those savers don't want to. So there's no free market, right? They're creating debt and they're stimulating the economy, trying to push up GDP, and they're taking money out of savers' pockets, which wouldn't be forcing the price of goods up, and they're pushing it in and forcing everything up. That's because, well, we won't get into that in this video, but they need the price level to rise. In a debt-based system, you need to actually create inflation so that debt created previously starts to get cheaper. If debt created previously starts to get more expensive, it becomes completely insolvent. It's insolvent anyway, but that would obviously be way worse. So they have to create inflation to try and make dollars, previous dollars taken out as debt, cheaper in purchasing power terms. In any case, we have government debt and Fed net liquidity, which you can see here are, very, very closely correlated. And so we know that right now we have huge fiscal deficits and huge debt creation in the States and in most other Western countries, actually in most countries. We also have, this is pension entitlements. This is unfunded entitlements in gold. Just as a kind of, a broad spectrum here, there's a lot of unfunded stuff. And the only way that gets paid for is debt creation. So we know that debt creation is going to continue. And at the moment, right now, a lot of debt is being created. Now, with that, we have Fed net liquidity, which seems to correlate with the amount of debt creation. So we have more debt creation, which should eventually lead to more net liquidity from the Fed, which is money printing, which is currency unit expansion. And as we know, Bitcoin tends to move in line with that. So all of that is pointing towards more debt creation, which leads to more liquidity, which leads to potentially risk asset prices pricing that in, right? And so BTC for right here, we know debt is being created right now, still potentially has a lot of that to price in if we're going into that expansion cycle, which looks like we are. Even though inflation is still above the Fed's target right now, it seems like they don't really care about that as much as the bond market, right? Because they've been doing QT, which is selling their assets, so selling bonds into the market, right? But they're stopping that or slowing that. So that will eventually come to some neutral amount, right? Where they don't sell into the market because there are too many sellers of bonds. You've got the Fed selling bonds, the US government selling bonds, other countries selling bonds for their own liquidity. Too many sellers of bonds, right? The bond market is the main thing. They need huge liquidity in that because they just have to create more currency units. There's not enough currency units to actually pay for all of the liabilities. So you have to keep creating currency units. And you have to do that, at a slow rate. Otherwise, you get these huge moves in markets where everything crashes. So this is, the system, the fiat system is they have to keep this rate of inflation at, a certain amount where it just is in this line and you don't have these huge crashes either way. And so they actually have to continue to create currency units, right? And so they have to continue to do that. They can't actually sell off the debt. They can't actually pay it off. It's impossible. So what they've said is they flipped, right? They flipped. They've said we're slowing down QT. We're slowing down this portion of inflation control. Now, whether inflation control actually happens, like whether inflation actually gets down to their target, it's kind of irrelevant because they've already said we're not worried about that now. We're worried about the bond market now, which means liquidity in. So whatever inflation is, it doesn't matter, and it doesn't matter for Bitcoin because go to a country where there's 100% inflation, Bitcoin is pricing it in at way all-time highs. So if the Fed say to us, we're more worried about the bond market through their actions, which they're doing, we're going to price that in. And if inflation doesn't get to 2%, that's too bad for people that aren't in assets, right? But the Fed have very clearly said through their actions, we're not worried about inflation. We're more worried about liquidity, and liquidity is starting to expand again, and Bitcoin is pricing that in. You can see here, this is net unrealized profit. We seem to have peaked out this cycle at 0.64 right here. This is way underneath what you would get in a typical bull market, which would be above the 0.7 range. So in the previous bull markets, you can see here, we topped out around the 0.7 range. For right now, nowhere near that. And we've actually drawn way down to this 0.53 in this little drawdown. That's why I think still a really good time to buy, even for this cycle, let alone for long-term investors, because we're not overheated for Bitcoin in any way. And the Fed have said they're more worried about liquidity than inflation through their actions. Do get the deposit bonus on Bybit. If you're a new trader there, check the link down below. The Crypto Investor course has 300 videos on getting yourself set up in crypto as well. I'll link that down in the description as well. I'm James, this is my ZG. Cheers for watching, and I'll see you in the next one.